Hello, everyone. At this stage, I am really eager to know if a financial crisis occurs, how will gold perform? And what about the US stock market and Bitcoin? Since last June, I've already been out of the market. I only entered with a 20% position midway through. Holding on to gold and cash for too long has felt uneasy, so I looked at how gold performed during the 2008 crisis, the price movements of gold, and then wrote a script. So that's the background. Now, for the main topic, subprime mortgage risk spilled over in 2007. The global financial system in 2008 entered a phase of systemic turmoil. The traditional view is that gold is a safe haven during crises, but the market performance in 2008 showed gold prices did not rise steadily, but instead saw sharp volatility and pullbacks. This video covers three questions. First, during the 2008 crisis, how did gold prices trend and what were its key phases? Next, how safe haven demand, liquidity, and policy each affect the price of gold? Third, under extreme circumstances, does gold still hold value as an asset allocation? There are two types of safe havens during a crisis. One is to hedge against long-term purchasing power risk, such as gold. The other is to hedge against immediate funding disruption risk, such as the US dollar and treasury bonds. During the most intense phase of 2008, the latter would outweigh the former. Hold on tight and get ready. Entering 2008, Chapter 1, Common Sense. Look at the chart's first phase, the victory of common sense. From August 2007, when the subprime mortgage crisis emerged, to March 2008, over these 6 months, the market's movements aligned with common sense during this phase. The crisis was labeled as the US subprime mortgage crisis. This was just a problem the US had brought upon itself. With the real estate market near collapse, the Federal Reserve had to begin rate cuts. Rates fell from 5.25, slashing all the way down. Cutting interest rates meant the yield on the dollar fell, so international capital began to sell off dollars. This pushed the US dollar index lower. Gold, priced in dollars, rose naturally. Meanwhile, safe haven capital flowed in, due to concerns about the stability of the US financial system, to pour gold in bulk. On March 17, 2008, a historic moment occurred. Bear Stearns was on the verge of collapse from holding a large amount of bad debt. It was on the verge of bankruptcy. In the end, with backing from the Federal Reserve, JP Morgan Chase acquired the firm at a very humiliating price, at the bargain price of exactly $10 per share. That very weekend, panic reached its first peak. Safe haven funds pushed the price of gold forcibly upward to the historic high of $1,000 per ounce. At that time, gold served as a hedge against a weak dollar, a traditional safe haven for investors. Friends, look, by late 2023 and the market in 2024, doesn't this scene look familiar? We're all speculating the Federal Reserve will cut rates and US commercial real estate might be about to blow up. As small and medium-sized banks are teetering, aren't Bitcoin and gold climbing together, setting new all-time highs? Early in a crisis, asset prices often rise as markets expect central bank rescue measures. At this stage, the market isn't short of money. What's lacking is confidence. It's just like before a storm hits. Everyone is frantically buying up umbrellas, driving umbrella prices sky high, but this is only the prelude to the disaster. Chapter 2, The Arrogance of Crude Oil and the Fake Fall of Gold. Gold has gone up, so why do institutions face margin pressure? The pressure doesn't come from gold itself, other holdings, other positions in gold. Since gold is liquid and easy to sell, it's often used as an ATM and sold for cash. Buying gold in 2008 to face the crisis head-on. Then, throughout the next 2 months, you would start to question your personal life choices. Look at this chart. A strange divergence appeared here. This is the crocodile's mouth. From mid-March to May 2008, just as everyone thought the crisis would worsen, the king of safe havens, gold, crashed. It plummeted 20%. Meanwhile, crude oil, the primary commodity, surged ahead. Why did they turn on each other? History has shown us that when crude oil rises, gold always follows. Because in financial markets, all asset prices are never traded based on reality, but on hopes. In March, the Fed rescued Bear Stearns, which was like giving Wall Street a shot of adrenaline. Traders breathed a sigh of relief. They created an illusion. Even a major risk like Bear Stearns was settled by the Federal Reserve. The worst had passed, and the financial system likely wouldn't collapse. With the crisis resolved, the gold used as a hedge naturally lost its value for existence. Massive safe haven funds cashed out, squeezing out the fear premium fully. To a certain extent, this can explain the sharp drop in gold from March to May. Fear led to a sell-off. Yet crude oil kept skyrocketing, revealing the astonishing arrogance of institutional traders at the time. Such arrogance. Even as ordinary Americans hit by the crisis cut back and lived frugally, the mainstream trend on Wall Street was still the decoupling theory. They were sure, even if the US hit a recession, China, hosting the Olympics, India, and other BRICS nations, still fast investing in infrastructure, oil demand from global emerging markets would remain strong. Large capital-controlled pricing power. Under Keynes's beauty contest theory, as long as institutions' models stayed bullish, with everyone trending and going long, crude oil prices may bypass the weak US economy and hit $147 a barrel. reaching a historic high. The $147 oil price, naturally, finally became the last straw that broke the camel's back. Crude oil is more than gasoline. It fuels all fertilizers, plastics, and fuel. High oil costs would seep into every cell of the economy, causing the US CPI that year to soar to a terrifying 5.6%. This forced the Federal Reserve into a dead end. Stagflation and a shortage of money meant rate cuts were desperately needed, but surging inflation forced the Fed to raise rates instead. Unable to bear the pressure from inflation, from May to July, gold, as shown in the chart, started to rise again with crude oil, but this increase wasn't due to risk aversion, but because gold regained its other identity, the king of inflation hedges. So the previous deep pullback seemed driven by event-driven risk-off capital exiting, plus institutional risk control and position reduction. Gold's fundamentals hadn't deteriorated. So what lesson does this segment teach us? It's a very harsh one. We must always be wary of the backlash from expectations. In other words, sell the fact, buy the expectation. If one day in the future, the market suddenly believes that the US economy will achieve a soft landing, succeeds, and there's no recession, while the US stock market and Nasdaq are celebrating, you might notice Bitcoin and gold are steadily declining. Don't find this strange at all. That's because the crisis premium is being drained away. But just like in the spring of 2008, this is often the calm before the storm. Chapter 3. The liquidity black hole. Everything gets slaughtered. Only the US dollar is God. In the autumn of 2008, the dollar was like oxygen. You might not even be optimistic about the dollar, but if you're short on oxygen, you have to scramble for dollars. Get ready. We are now entering the most brutal, the bloody, counterintuitive third stage of 2008, the liquidity black hole. On Sept 15, 2008, Lehman Brothers went bankrupt after 158 years. The heart of global finance froze instantly. Logically speaking, it felt like the world's end arrived and gold should have soared. But in reality, at the very moment when the real crisis broke out, not only did gold not rise, it was slaughtered along with crude oil and US stocks, hitting a low of $686, falling back to its 2007 starting point in one breath. And during this process, despite the US being the crisis epicenter, the dollar index actually experienced an extremely strong one-sided surge. Why did America struggle? The dollar still became the strongest king. Mid-crisis, gold ends up being heavily dumped. To understand this phenomenon, I reviewed many sources and found a report from the Bank for International Settlements in 2009, which was more than 12 individual pages long. I found the most fundamental truth. The BIS report revealed that during the market crash, there were actually $4 pumps at work. The first pump, the end of carry trades. Before the crisis, many institutions would borrow dollars and yen at extremely low interest rates to buy high-yielding Australian dollars or assets from emerging markets. When the panic index soared to a historic high of 80 in October, all high-yield assets plummeted across the board. To stop the losses, institutions frantically sold overseas assets and bought dollars to settle debts. This led to a very substantial amount of passive dollar purchasing activity in the market. The second pump, a persistent structural dollar shortage. The report mentioned an extremely crucial piece of data. Before 2007, European banks bought massive amounts of US assets, such as MBS, mortgages, and securities. But they didn't have that many dollar deposits on hand. At the same time, they also didn't want to keep a lot of dollars themselves. So what did they do? They would borrow short-term dollars in the interbank lending and foreign exchange markets to buy long-term dollar assets. Once Lehman collapsed, the interbank market froze instantly. No one dared to lend money to European banks anymore. These banks immediately faced a supply cutoff. In order to avoid default, they could only go to the spot market and massively buy dollars regardless of cost. This desperate price-ignoring buying just to survive pushed the dollar exchange rate skyward. The third pump, excessive institutional hedging, it's somewhat similar to the second pump. European and Australian pension funds hold a lot of US stocks. To guard against the depreciation of the dollar, they often short the currency as a hedge. This is actually easy to understand. Many institutions, unlike US retail investors, don't directly buy spot assets to hedge. They're more adept at using financial instruments. Normally, this isn't a big deal. But when a crisis hits, for example, when US stocks plunge, their US stock assets shrink in value. This causes their short dollar positions to become overloaded. To close out these excess short positions, these financial giants have no choice but to buy dollars in the market in the opposite direction. Now, the fourth pump, which is actually the most fundamental reason for the plunging gold prices, is the liquidity and leverage collapse triggered by margin calls. When Wall Street's hedge funds are hit by the blow-up of junk bonds and receive margin call notices from their brokers, they no longer have any cash on hand. Since junk bonds simply can't be sold, in order to get cash and survive, they can only sell, with tears in their eyes, the most liquid and easiest to cash out assets in their portfolios, which is gold. This is the most valuable conclusion. Crises come in two forms, solvency and liquidity. At the peak of its liquidity crisis, everything gets sold off. The correlation between all assets approaches 1. Only the US dollar is king. If you believe that in the near future, the US economy will experience a severe hard landing or that US stocks will crash, then please give up the fantasy that Bitcoin and gold will immediately surge as safe havens. Because in this era, Bitcoin has long been turned into an ETF product by Wall Street. At the early stage of a liquidity crunch, Wall Street institutions will not act like holders. They will definitely dump their holdings without hesitation, selling off Bitcoin in exchange for US dollar cash to cover margin shortfalls in US stocks. In the first wave of a liquidity shock, Bitcoin will fall sharply with the Nasdaq experiencing a cliff-like drop. But this is also our opportunity, isn't it? Isn't it? Chapter 4, the ultimate safe haven. When the doomsday moment arrives, as the US dollar and gold aligned and we pass the liquidity crisis's darkest moment, we're reaching the strange yet fascinating fourth stage on this chart. By the first quarter of 2009, at this point, the Federal Reserve had already launched an unprecedented QE, madly printing money. Take a close look at this blue box I've marked. In the textbooks, gold is priced in US dollars. When the dollar rises, gold should fall. They're supposed to be on opposite ends of a seesaw. But in the first 3 months of 2009, the dollar and gold actually rose together. Rare. What exactly happened? The answer is just one word: despair. At the beginning of 2009, while the liquidity crunch panic eased slightly, the market was hit by an even deeper fear, a crisis of liquidity and solvency, and a major shift in the trust in fiat currency. Back then, US stocks hit new lows, with the S&P 500 hitting 666. Rumors even scarier than the Lehman Brothers collapse were swirling over Wall Street. Would Citibank and Bank of America also be unable to hold on? Would the US government let these giants be directly nationalized? At that moment in time, the script of the world had become like this. Why was everyone scrambling for US dollars? Because it was a world of who's the least bad. Even though the dollar was in trouble, Europe was in even worse shape. Eastern Europe was even facing the risk of sovereign defaults. The euro's plunge caused the dollar index to rise passively, and on top of that, no one dared to buy any stocks or bonds. Cash was still the safest defensive shield. But why? While holding US dollars, was everyone also frantically buying up gold? Because trust had collapsed. Investors had fallen into deep self-doubt. If Citibank were nationalized, would the US dollar deposits I have in the bank still be safe? Could they be frozen? So the smart old money could foresee that. Even though the US dollar is king today, the massive amounts of greenbacks printed by the Fed in the future will dilute the purchasing power of fiat currency. So capital made its ultimate choice. On one hand, they held large amounts of cash, and on the other, they bought gold. Because physical gold carries no counterparty risk whatsoever, it is the only safe haven when fiat currencies collapse. Part 3, I urgently need cash, so I sell my gold. Part 4, although I now have cash, I no longer trust any fiat currency, so I use cash to buy gold. When both gold and the US dollar rise together, the market isn't choosing between them, but is buying doomsday insurance. The dollar hedges a current collapse, while gold hedges against buying power loss. In today's video, I also have a conclusion, which is about Bitcoin's true nature. Is it ultimately a prisoner of liquidity, or the gravedigger of fiat? We know, it's true, that ever since Bitcoin was first created, its narrative has mainly revolved around a peer-to-peer cash transaction system. After the fork in 2017, its trajectory was directly shifted to SOV, which means store of value. But with the approval of ETFs and the entry of many US institutions, major companies began purchasing Bitcoin. Its price, unlike the 2017 cycle, the 2021 cycle, shows a totally different trend. We know that history never repeats itself exactly, but it always rhymes. After reviewing the 4 phases of gold's price movement in 2008, we can finally begin to answer the ultimate question of the present, the Bitcoin in your hand. Is it essentially a highly leveraged Nasdaq tech stock, or is it truly digital gold? I think many believers in the crypto space would loudly proclaim that Bitcoin is a safe haven, but this is actually inaccurate. By extrapolating from the 2008 framework, the fate of Bitcoin depends entirely on which crisis scenario we end up with. I've listed a total of 3 crisis scenarios. First is scenario A, a successful soft landing for the US stock market and an abundance of liquidity. The likelihood of this scenario happening is not high. Scenario 2 is a liquidity crisis and hard landing. It's a repeat of chapter 3 from 2008. In this stage, Bitcoin isn't a safe haven. It will fall harder than other assets, but we know it will definitely come back. The third scenario is the one I find least likely, yet it's where Bitcoin truly becomes legendary, a sovereign debt crisis and a revaluation of fiat credit, a repeat of chapter 4 from 2009. That is, if the source of the next crisis is not Wall Street investment banks, but America's massive $37 trillion in unpayable sovereign debt, when the Federal Reserve is forced to step in, printing endless money to buy the debt. That will be Bitcoin's chance to make its most thrilling leap. But regarding these 3 scenarios, I still haven't found overwhelming evidence to convince myself. And so then, let's leave the details for another time. After talking about so much, what I want to share is, don't blindly believe in any asset not even gold or Bitcoin. At times of extreme liquidity crunch, the US dollar is king. This is when future. Use data to uncover macro illusions. See you next time.